Hi everyone, Andrew Thompson here from JBWere's Investment Strategy Group. Well, we're about 90% of the way through US quarterly reporting season, so we thought it timely to give you a bit of an update as to some of the things we're seeing. Broadly, we've been really happy, with the US generating earnings growth of about 23%. Now that's versus our expectations for the quarter of about 20% and nearly in line with last quarter's stellar result. Tax reform has obviously helped, but importantly, we've seen sales growth of about 10%, which you don't get that sort of sales growth unless you've got pretty strong underlying economic momentum. So far, roughly 3/4 of companies have beaten analyst earnings expectations, and over half have beaten by at least one standard deviation, which is the highest rate since about 2010. At the sector level, healthcare has been particularly strong, with nearly all companies beating analyst expectations at the earnings line. Technology has also been very good. Now, one could be forgiven for thinking that technology's had a bit of a rough ride with the movement in stocks like Facebook and Twitter on the day of their earnings results. But the sector is still generating very strong earnings growth. And importantly, earnings revisions have been moving upwards since the start of earnings season. At the other end of the spectrum, energy has been weak, and that's despite a higher oil price. But in saying that, we do expect that higher oil price to drop through to the earnings line and for the sector to generate good earnings growth for the full year of 2018. Moving across to Europe, we're about 2/3 of the way through earnings season, and we've seen an average earnings surprise of about 1.5% to the upside, and that's roughly in line with history. Financials have been very good, similar to the US, where we've seen good earnings growth come through, as well as the return of credit growth and a vast improvement, shall we say, in credit quality. And also similar to the US, energy has been a little bit weaker despite that higher oil price, but in saying that, these companies are generating good free cash flow growth, and we do expect good earnings for the full year. Autos is one sector that we watch very closely, given it's in our global themes portfolio, and the sector's delivered roughly in line results, but with good free cash flow generation, which is what we want to see out of the sector. And importantly, autos has been one of the only sectors outside of commodities with positive earnings revisions year to date. Now, one of the key thematics we have seen this reporting season across both the US and Europe are the quite sizable moves in some stocks share prices on the day that their earnings are released. And stocks like Facebook and Twitter, as mentioned before, come to mind, as well as some of the autos like Peugeot and Fiat Chrysler. Now, this doesn't surprise us, although it can be quite unnerving for investors. The reality is that we are late stage in terms of the market cycle, and there is a lot of good news and a lot of growth expectations built into some of these share prices. So any misses versus expectations in terms of outlook and revenue guidance going forward can cause these quite big moves in share prices. But in saying that, earnings are still growing very strongly. And when we combine that with a robust macro environment, as well as low near-term recession risk, we certainly remain constructive on equity markets through the second half of this year. So I'll finish there, but as always, please get in touch with your JBWere advisor if you have any questions. Thank you.